Hi, I'm Jim Jubak, and welcome to my YouTube video for May 14th. Those of you who are regular fans see that I've changed hats, at least for the short term, giving the Toledo Mud Hens a rest and going with the Jacksonville Jumbo Shrimp. If you want more of me, you can go to my free site. It's jubakpicks.com. The 3 portfolios, stock picks, market commentary. Today, for example, we're going to talk about inflation. There'll be a post on inflation on the site, or you can go for even more stuff to my paid site, jubakam.com, and that's got, instead of 3 portfolios, it's got 6 portfolios. If you're a millennial investor, college student, recent college graduate, I hope you'll check out my half-price offer for the subscription site. Basically, what I'm trying to do is to give you a chance to get some advice about the market while you've got a lot of time, but not necessarily much money, so that's why I've slashed the price. And not just for this year, but it's for a 4-year stretch so that you get to pay half price for all of your college career or for 4 years while you're trying to make money. Today's topic is 5 stocks for an inflation scare. And that's the market that we've got today. The CPI, that's the Consumer Price Index, came out this morning for April. And it was, everybody expected that we'd see a bump up in inflation, but boy, did we get more than a bump. Basically what we got, and I need to look at my papers, is that what's called the all items CPI, that includes food, energy, etc., went up 0.8% in April, and after a pretty good run higher in March, we're now looking at a 4.2% inflation rate for the last 12 months. Remember that while the CPI is not the number that the Fed looks at, in fact, it runs a little hotter than the Fed's measure, the Personal Consumption Expenditures Index. Still, the Fed's target for inflation is 2%. So at 4.2, we're way above that. The core rate, which takes out volatile and food inflation, still ran at a really high rate in April with an increase of 0.9%, and is now running at 3% for the last 12 months. Again, way over the Fed's index. So the market today is saying, hey, with that going on, the Fed is going to be under pressure to slow down the economy, and that would mean higher interest rates, or at least getting rid of the $120 billion in purchases of treasuries and mortgage-backed assets the Fed is doing each month. Higher interest rates mean that we really need to re-rate the entire stock market. That's what we're seeing today. What we're not seeing is a kind of rotation into inflation stocks. What we're basically seeing is pretty much everything sell-off, with some exceptions. So this is the chart for Southern Copper, which I just mentioned. You can see that stock has had a really, this is a six-month chart, so it had a really great run, a couple of peaks, another peak here. You know, copper is in short supply, demand is going up, both because the global economy is coming back and because of alternative energy sources, whether it's electric cars or wind power, require more copper. So you've had a really great run in this. I still recommend this going forward. I think today might even be a buying opportunity, but we're not looking at a big gap. We're looking at 2% down. So I still like this going forward. I own it. It's in the portfolios. I would still recommend it here as a great inflation play. Second stock. Okay. One of the also things we're not seeing today is, you know, if the economy is overheating, you'd expect to see sort of post-vaccine recovery stocks going up really well. And we're not. We're seeing them sell off. As I said, the entire market is selling off because we're re-rating everything. One of the post-vaccine recovery stocks that I really like is Macy's. And this is a 6-month chart. The peak here, drop back down. But what's interesting to me is from here, which is March 24th, we've pretty much had a very steady climb. Macy's is not one of the world's healthiest retailers. It's not in a particularly healthy segment of the retail market. But what we're looking at is a low price stock that everyone was really discounting that has moved up. Today we're down, last I looked, it was down about 2.32%. This is a stock that I might use options to play because you're looking at probably pretty good retail sales in It's the summer months, so you might want to try to leverage that, but also just the stock as a whole. I don't know that we'll get back up here, which is, $20, but at 1688, which is where we are right now, getting back to 18 or so would give you, what is that? Let's say if you got to 19, you'd be looking at roughly 20%. So those are two. I also like the bank sector. And here I'm going to look at a stock called U.S. Bancorp. Banks, if you're looking for green in today's market, there's almost nothing. Coke, last I looked, was up a whopping 0.06%. Caterpillar is up a little bit, like 0.35. CVS, which was up earlier in the day, turned negative. But banks are all in the green. And you might want to ask, well, why is that so? Because banks will make more money if interest rates go up. So in some sense, they're an inflation response play. They're betting that the Fed will actually start to raise rates. Banks like that environment because, hey, they borrow at the short end of the market, lend at the long end. So what you're seeing is that as 10-year rates go up, which is the benchmark for mortgages, the banks make more money. USB is really the largest of the regional banks. It's very close to being not a regional bank. It's very big. It's very well run, has a very nice market. And as you see, it's been just climbing steadily. So today we're looking at last I looked again, we're up a little bit, like 1.2%, pays a decent dividend. Here's one that I think this is a good stock to be looking at if the market is going to continue to bet that the Fed is going to raise rates. I'd want some exposure in the bank sector. USB, Bank of America, Wells Fargo, Citigroup would be stocks that I'd look at, and of that group, I'd like USB the best. Okay. The last thing to note is that on a day like this, when really everything is selling off and nobody really likes stocks in general, one thing that crucially you should do with part of your portfolio is you should ignore this. You should use it as an opportunity to say, hey, there are stocks out there that I'd really like to own long term, and this is a buying opportunity or a dollar cost averaging opportunity. Two things that I'll be looking at here. This is for a chip stock, Infineon. They're one of the biggest players in the stock in the silicon chips for autos market, which is going to be a growing market. The amount of silicon in cars is astounding. You're talking about 1,000 chips. This stock was moving up readily, and then what we got in here was a global chip shortage. So what you start to get here is a kind of pullback based on problems in the auto sector in getting chips, auto manufacturers cutting back their orders, and that's had an effect on a stock that was doing very, very well. But you notice, if you look at this, we've come through, we've put in a new lower low. I would say that the next level we're looking at here is the stock right now is at 36.62. There's some support here. I would certainly look for this to be another level to check. So this is a good stock to be dollar cost averaging into. It's down about 4.6% today, so you got a good place to start. There's another stock which is operating in the same sector, NXP Semiconductor. They also sell into the auto market, and like them for the same reasons. I would add both of them. I own both of them personally, and they're also in Jubak Picks portfolios. These are long-term plays, so again, dollar cost averaging would be really good. They're down, well, about 4% today, but you notice that until we hit that same kind of period, this is a one-year chart as opposed to a 6-month chart that I use for Macy's and things like that, so you can get a better sense of the run. What you're looking at here is the chip difficulties. I think you're looking at a reset in prices, so maybe a little bit here, buy a little bit here, maybe buy a little bit here if it keeps going down. But I certainly look to hold this for the long term. The question going forward is this: is the Fed is saying that this is a temporary jump up in inflation, that we're not really looking at 4.2%. What we're looking at is a bump in inflation due to disruptions in the global supply chain, due to the pandemic, due to a ship getting stuck in the Suez Canal, and that we're going to see some of these problems work through. The Fed is saying we're seeing that in the labor market, where you've got a real, because people have been unemployed for so long, you've got a real mismatch between their skills and their jobs, and people trying to decide whether I want to change careers and la 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 la. Let me give you an example of how difficult this can be. Let's go to copper. Now, copper is a great inflation play. How much of the increase in copper is really related to increase in global demand because of the global economy picking up and because of alternative energy, and how much is related to problems in supply chain? Well, one of the big problems in supply chain right now is copper miners use sulfuric acid to do the first take of getting copper out of rock. Sulfuric acid requires sulfur. Sulfur is a product produced by oil refiners and then turned into sulfuric acid. Well, there hasn't been, there's been a slump in oil production, slump in oil refining, so there's been a real shortage of sulfur. I think you're still looking at inflation in the market. The Fed is trying very hard to buy itself enough time to figure out what's going on. So, they've got a big meeting coming up in June, and a lot of people in the market are thinking that the Fed is going to make some kind of statement that would set up a slowing of their monthly bond buying, now $120 billion a month, and maybe set up an earlier than expected interest rate increase. That's one of the fears going on in the market, because right now, until today, a lot of the prices we're looking at the Fed's rate staying at 2% or below for a long, long time, until like 2027, for example. Not saying rates wouldn't go up, because they're at, essentially zero now. So 0 to 2% would be a big increase, but sort of topping out at below that. And there are people out there, including William Dudley, who's former head of the New York Fed, Lauren Summers, saying, hey, it's not 2% is probably not the top, 4.5% might be the top. These guys don't know any more about where the top is in inflation than I do, than you do, but nonetheless, somebody with that stature coming out and saying, hey, 4.5 is enough to really, really put fear into the market, and that's what we're seeing today. One of the ways to track how much fear there is to look at the VIX, which is the Chicago Board of Options Exchange S&P 500 Volatility Index. The VIX tracks what people are willing to pay for hedges against risk. What we've seen is this move up from about 17 to, when I looked today, it was 24, and it's a swing, a huge swing in about a week. The VIX is up sort of midday today, about 11% again. So it's clear that people are looking for an increase in risk, looking for an increase in interest rates, and looking to hedge their bets going forward. This is Jim Jubak. Thanks for watching today. If you like this, please like it on YouTube. Please subscribe to the channel. And remember, if you're a college student or a recent college grad, look for my millennial offer, half price for 4 years for you to get started in your investing career. One more thing, leave me a comment and tell me what you'd like me to cover in these videos going forward. So thanks very much for watching. I hope to see you next week.